Millions of Americans over 65 may qualify for a significant new tax break, but a large number of retirees are missing it because they do not know it exists or are not sure whether it was included on their return. This is not a future proposal. It is not something being debated in Congress. It is already law. It was signed on July 4th, 2025, and it applies to your 2025 tax return, the one you may have already filed or the one you still need to file. If you are 65 or older, stay with me for the next 10 minutes, because by the end of this video you will know exactly what this break is, whether you qualify, what it is worth in real dollar terms, and what to do if you already filed and are not sure whether it was included correctly. If you are not subscribed yet, hit that button right now and turn on the bell. Tax law changes that affect your retirement income happen every year. When they happen, the IRS does not send you a plain English explanation of what it means for your return. This channel does. Subscribe, and let's get into it. Let me start with what this actually is, because the name of the law that created it is getting a lot of attention, and I want to make sure you understand exactly what it does, and what it does not do, before we get into the numbers. On July 4th, 2025, the One Big Beautiful Bill Act was signed into law. It made several changes to the tax code. The one that matters most for seniors is a brand new provision called the Enhanced Senior Deduction. Here is what it does in plain English. If you are 65 years old or older by December 31st of the tax year, you can now claim an additional $6,000 off your taxable income. This is separate from and stacked on top of the standard deduction you already take. It is also on top of the existing age-based addition that seniors already received before this law existed. If you are married and both you and your spouse are 65 or older, that becomes $12,000 combined, $6,000 each. Now, I want to be direct about something because there has been confusion online about this. There was significant discussion during the campaign about eliminating taxes on Social Security entirely. That specific provision was not included in the final law. Under Senate rules, directly changing Social Security taxation required 60 votes. A threshold that was not reached. What the law does instead is add this $6,000 deduction to your overall taxable income. For many lower and middle income retirees, the practical effect is very similar. It can substantially reduce or, in some cases, eliminate the federal tax they owe on their Social Security benefits. But it works through a deduction, not a direct Social Security exemption. That distinction matters when you file. Now let me walk through who qualifies. And I want you to pay attention here, because this is exactly where people count themselves out when they should not. The income thresholds are more generous than most people assume. If you file as single, you can have a modified adjusted gross income of up to $75,000 and receive the full $6,000 deduction. Above $75,000, the deduction begins to phase out gradually. It reaches zero at $175,000 for single filers. If you are married filing jointly, the full $12,000 combined deduction is available up to $150,000 in combined income. The phase-out reaches zero at $250,000. Here is something important about how that income number is calculated. Your modified adjusted gross income for this phase-out is calculated before the $6,000 deduction itself is applied. So the number that determines your eligibility may be lower than what you assume when you look at your total income. And here is the part that surprises a lot of people. You do not have to be retired to claim this. If you are 65 or older and still working, you qualify. The law does not require you to be receiving Social Security. It does not require you to have stopped working. The primary requirement is age, 65 or older by December 31st of the tax year, combined with a valid Social Security number and filing as single or married filing jointly. And this matters if you typically itemize your deductions. This deduction is available whether you take the standard deduction or itemize. It does not replace either option. It stacks on top. So if you itemize because of high medical expenses or charitable contributions, you can still claim the full $6,000 enhanced senior deduction on top of your itemized total. Now let me show you what this looks like in actual dollar terms, because the word deduction can feel abstract until you see the math behind it. A deduction reduces the amount of income your taxes are calculated on, not your tax bill directly. So the value of a $6,000 deduction depends on your tax bracket. For a single senior in the 12% tax bracket, The full $6,000 deduction saves approximately $720 in federal taxes. For a married couple where both are 65 or older, also in the 12% bracket, the $12,000 combined deduction saves approximately $1,440. For seniors in the 22% bracket, the single filer saves approximately $1,320. The qualifying couple saves approximately $2,640. And remember, this stacks on top of the standard deduction and the existing age-based addition. Consider a single senior taking the 2025 standard deduction of $15,750 plus the existing age add-on of $2,000 plus the new $6,000 enhanced senior deduction. Their total deduction shield is $23,750. That is a significant amount of income protected from federal taxes. And for many retirees on modest Social Security and pension income, it eliminates their federal tax liability entirely. Now, let me talk about how this deduction is actually claimed, because this is the part that is causing the most confusion, and where some people are missing money they are entitled to. The enhanced senior deduction is reported on a new form called Schedule 1A. The IRS created this form specifically for the new deductions introduced by the One Big Beautiful Bill Act. If you use tax software, TurboTax, H&R Block, TaxSlayer. The properly updated versions will prompt you with age and income questions, and generate Schedule 1A for you automatically if you qualify. The key is making sure the software is current and that you answer those questions accurately. If you work with a tax preparer, the conversation to have is straightforward. Ask them directly. Did my 2025 return include the enhanced senior deduction under the One Big Beautiful Bill Act, and was Schedule 1A attached? A good preparer will know exactly what you are asking and can confirm whether it was included. If you filed on paper without tax software or professional help, and you are not certain whether Schedule 1A was part of your return, that is worth verifying. I want to be careful here about how I say this because I am not a tax professional and your situation is specific to you. What I can tell you is that the deduction requires Schedule 1A to be filed alongside your return. If you have any uncertainty about whether it was included correctly, that is a question worth asking your preparer or checking with your tax software directly. Now let me talk about what happens if you already filed and the deduction was not on your return. There is a process for this. It is called an amended return. The form is 1040-X. An amended return allows you to go back and correct a return you already submitted. If the $6,000 enhanced senior deduction, or $12,000 for a qualifying couple, was missing from your 2025 filing, you can file a 1040-X to claim it and recover the difference in taxes. The IRS typically takes between 10 and 16 weeks to process an amended return. That is longer than a regular filing. But the correction is legitimate, and the refund, if one is due, will be issued once the amended return is processed. You have 3 years from the original filing deadline to submit an amended return. For 2025 taxes, that window runs through April 2029, but there is no reason to wait. If the deduction was missed, the sooner the amendment is filed, the sooner it gets processed. If you are considering this, I would recommend speaking with a tax professional rather than navigating it alone, especially if your income is near the phase-out range or your return has multiple income sources. The math is specific, and it is worth getting right. Let me also address 2 assumptions I hear from seniors who decide this does not apply to them. The first is the income assumption. Many seniors look at their total retirement income, Social Security, pension, IRA withdrawals, investment income, add it up, and conclude they are over the threshold. Before you do that, remember that the phase-out for single filers starts at $75,000 and is not complete until $175,000. For married couples, it runs from $150,000 to $250,000. Even a partial deduction in that range is real money. And again, the income figure used for the phase-out calculation is your modified adjusted gross income before this deduction is applied, which may be lower than your gross income figure suggests. If you are anywhere near those ranges, it is worth checking the actual number rather than estimating. The second is the itemizing assumption. Many seniors who itemize assume this deduction only works with the standard deduction. It does not. Schedule 1A is separate from both Schedule A and the standard deduction line on Form 1040. You report your itemized deductions the same way you always have. And the enhanced senior deduction sits alongside that on Schedule 1A. Both flow to your total. Do not count yourself out based on an assumption you have not verified. Let me bring everything together. The enhanced senior deduction is a new $6,000 deduction, $12,000 for qualifying couples, created by the One Big Beautiful Bill Act, signed on July 4, 2025. It applies to tax years 2025 through 2028 and expires after that unless Congress acts to extend it. To qualify, you must be 65 or older. By December 31st of the tax year, have a valid Social Security number, and file as single or married filing jointly. The full deduction is available for single filers under $75,000 in modified adjusted gross income and for joint filers under $150,000. It phases out above those thresholds. It is available whether you take the standard deduction or itemize. It is claimed on Schedule 1A attached to your Form 1040 or 1040 SR. It does not eliminate taxes on Social Security directly, but for many retirees, it substantially reduces the federal tax owed on those benefits. If you have already filed your 2025 return and you are not certain whether this deduction was included, the right first step is to contact whoever prepared your taxes or check your filed return for Schedule 1A. If it was missing and you qualify, a 1040X amended return is the path to recover what you are owed. This deduction was designed specifically for people like you, seniors on fixed incomes who worked hard their entire lives and deserve every dollar of tax relief the law provides. The only way you miss it is by not knowing it exists, or not making sure it was filed correctly. You know it exists now. Before you close this video, share it with one person you know who is 65 or older. A parent, a neighbor, a friend, someone from church, especially anyone who has already filed their 2025 taxes and may not have heard about this deduction yet. One conversation. That is all it takes. Subscribe and turn on the bell. I will see you in the next one.